Welcome to the InterMarket analysis video update. This is a weekly video where we look outside of the S&P 500 to look at other markets, other sectors, other indexes, and compare them to the S&P to see if we can get some insight as to what's happening with the S&P 500. I also go through and look at the earnings, both on a historical basis and a forward-looking basis for the S&P to see if we're overvalued, fairly priced, or inexpensive. And then I do a pretty extensive breakdown of growth versus value. And we want growth to outperform value when the market's more positive. If value is outperforming growth, that's when the market is becoming more negative. This is being prepared for Monday, February 24th. The first area is S&P 500 valuation. And there seemed to be some news this past week that the market was becoming concerned about valuation. Well, look at this. We've been above with the price of the S&P 500. We're above this red dashed line. Whenever we go above that red dashed line, the market is considered to be overvalued. And we've been above this line going back to 2022. So the fact that it became kind of a problem just on Friday, it's like, okay, this has been around a while now. And so the market is trying to pick out something that it's a little bit concerned about, because you can see here's the S&P, here's the PE ratio of 20. When we're above that level on a historical basis, we're considered to be expensive. This also just goes back to 1980 and looks at different events and what the valuations were at that time. And you can see we spend years above this red dash line. Sometimes we drop a little bit below it. That's what we saw going into the financial crisis. Then we came up out of that. And there are times when we're below it. And that's usually, at least once things get settled, that can be more positive. Well, after coming up out of the COVID crash here, we've been well above it ever since. Also, another take on this is to take a smoothed approach, looking at earnings over a 10-year period of time instead of the previous chart, which just looks at earnings as they've been released. This was developed by Robert Shiller. The latest reading coming in here is at 37.9. Well, you can see this is pretty high when you go all the way back to the 1800s, but we've been high now for a long time. Also, we look at the median and the mean, which is between 16 and 17, and we're over double that. So yeah, we are overvalued, but this didn't seem to be a problem 3 months ago, 6 months ago, a year ago. We were seeing very similar readings here, but the market didn't seem to care. This also looks at standard deviation with that same Shiller PE ratio, and we're well above the standard deviation of +1 here. And when we get above that, we are considered overvalued, and we've been above it now for quite some time. But then the market looks forward at potential earnings that may be released going off into the future, and then creates another PE ratio based on that. And there are 4 indexes that we have here. The first one on top, which is in purple, that's the mega cap 8. And they've been falling, but they're still up well above that level of 20 at 28.7. Even though they've been coming down, we actually got up into the 30s. We use that same 10, 15, 20 scale, and here we're coming in at 28. Well, this is part of the reason why the market is suddenly now becoming worried about valuation. But we've been a lot higher than this in the past, and it didn't seem to present a problem. We're also above 20 with the S&P 500 forward PE ratio as well. We're getting up to 21.8, just a little bit under 22. And then I'm going to go through a different chart here in a moment, but notice the small caps here coming in at 15.3 on a forward-looking basis. That's more fairly priced, but because of the higher interest rate environment and because of the earnings of small caps, they may be fairly priced, but they're not as attractive right now. Also, during this time of year, they should be really going up, but they haven't been. We saw that happen a year ago where it looks like they were breaking out to the upside only to pull back. And we've seen that multiple times in 2024 going into 2025. Also, the mid caps are right around this 15.6 level. This is the chart, and I went through this in the daily video because I'm seeing a discrepancy here. When you look at the NASDAQ 100, which I don't have a separate chart for that, we're coming in at a current rate of 29. That means we're overvalued. We should be down around 20. Then I'm going to skip over this one. And then the S&P 500 is about at 22, and that's what we're seeing in the previous chart. And then I don't have an additional chart for the equal weight. That's coming in at 17. That's the rest of the S&P 500 where all the stocks are treated together. And that's more fairly priced. It's not above 20, but it is above 15. So that's a pretty good PE ratio right there. And the mid caps, kind of close to what we're seeing now. The discrepancy is in the second column right here, where if you remember back to this previous chart, the green line here is coming in at 15.3. But if you look at it here, it says it's coming in at 25. That's quite a difference right there. So something is different between the two. Personally, I would go back to this chart. It's put up by Edward Yardeni at yardeni.com. And we follow this every week, where this is a chart that just came up that I've just seen one time. So I would default back to the previous chart if you were using that to make some kind of a decision. I don't use these charts to make decisions. This is more just for informational purposes. We use other things. We use technical analysis. This is more of fundamental analysis, which we don't ignore, we don't throw out, but we don't necessarily use it to decide when we're going to get in or when we're going to get out of things. If you had decided back here, once we got above 20, to get out because the mega cap 8 was looking really expensive, you look at all these gains you would have missed. So, yeah, I mean, there's logic behind this, but there's also stock market logic, and we can become overvalued for long periods of time. Okay, then I also look at growth versus value. The first thing I look at is just growth by itself. It's been pulling back, and especially in Friday session, it really took a hit. It was down 3.55%. But overall, it's still in an uptrend when you look at this chart all by itself. Value, which was down a lot less, it's coming back down to its 50-day moving average. It's also in an uptrend. So when you look at these independently, we want growth to be doing better, but they're both doing pretty good all by themselves. Where we get some additional insight is when we look at ratios between the two. And even though we're pulling back right now, growth still continues to outperform value. This is an inversion of that same chart where value is underperforming growth, even though it's been bouncing back up. So that hasn't changed. And we're seeing that the long-term trend is suggesting that value is underperforming growth, or to say it another way, growth is outperforming value. We look at a couple of ETFs, and this is longer term, also showing how growth is outperforming value. We've been seeing that now for quite a while. Here's an inverse of that same chart showing how value is underperforming growth. Then we look at some indexes longer term, also pulling back. We're seeing some weakness right now, but we haven't seen a change in the bigger picture yet. This is what we're going to be watching for. If we continue to fall, the blue line turns and goes down and it crosses below the red line, that means things are changing. Like we saw back in 2022. Yeah, we're pulling back and we're showing some weakness right now, but we haven't changed the bigger picture yet. Here's also an inverse of a shorter looking chart. Even though value has been bouncing back up, it's still in a longer term downtrend when compared to growth. Also another index, shorter term as well, pulling back as far as the strength is concerned, but still in an uptrend, showing that growth is continuing to outperform value. We look at a growth versus value ETF. This is showing us a little bit of weakness, and we're watching this. If this continues to fall and we see this confirmed by other growth to value charts, then we might change our stance. But for the most part, this is holding up, even though it's probably the weakest of the charts we're looking at when we do these growth versus value ratios. And this is value showing how it's performing with growth. Also, it's bouncing back up, but still underperforming long term. Then we look at the small caps, and we're getting a little bit concerned about this. You can see the index really not been going anywhere, and then boom, we just jetted down. We're actually dealing with the 200-day moving average with the small cap index. There's two small cap indexes that I look at. There's this one, the S&P 600, and then there's the Russell 2000. And we're right at the 200-day moving average with the Russell 2000. Now, we bounced up off of that before. The question that we're watching for the upcoming week is, can we bounce up off of that again? And if we break through it to the downside, that may mean things are turning even more negative for the small caps. Mid cap growth of value, looking good, still in an uptrend, but seeing some weakness now, falling below its 50-day moving average. S&P growth of value, also in an uptrend, but pulling back and dropping underneath the 50-day moving average with this ratio. Then we switch gears a little bit and we look at a long-term chart of inflation. And this is the CRB index, which are commodities, which are in an uptrend right now, and that's causing some concerns in the market. But then we do a ratio between inflation versus deflation. Even though we're coming back up, we started back in late 2024 and we're continuing to go up, even though we're leveling off here, we're still below a declining moving average. So this is not showing in the bigger picture that inflation is becoming more than just kind of a short-term setback. Here's a daily chart of the CRB index. This is in an uptrend, and this is what's causing some concern in the markets. We look at the Baltic Dry Index, still in a downtrend. This is also inflationary. If this was going up, that would be more inflationary, where it's still in a downtrend overall. And then inflation expectations. Yeah, they've been going up, going back to the low that we set after the COVID crash, but we actually are declining so far in 2025. We want to keep an eye on some other markets. We're starting to see a downtrend now with aluminum, where we're in an uptrend with corn, and we're also starting to see an uptrend here with wheat. And we look at fertilizer, and this is an even longer term chart than in the video I did a week ago. And we are going up with fertilizer here, but we're not back to some of the high levels that we were seeing back in 2022. We want to keep an eye on oil. It's actually dropping, even with all these geopolitical things going on. This is getting down into the lower end of the 70 range. We look at a gold to oil ratio. When this is going up, it just means the gold's outperforming oil. And then we do a correlation. We look at the 10-year yield, which lately has been coming down. Oil has been coming down. And we see that we're almost neutral here, but we're seeing a little bit of a pickup in the correlation between the two, which when there's a high correlation, when we get a reading up here close to 1, that means they're going up and down at the same time. They're either both going up together or both going down together, leaning more towards neutral currently. We want to keep an eye on gas. It's still in a downtrend, but it's really been bouncing back up lately. If we stay above both of these lines, we could see a golden cross here, which would signal a new uptrend for gas. Heating oil also starting to show that it could be generating an uptrend after being in a downtrend. Natural gas is in an uptrend. It's really been going up. It dropped to under 2 here for a while. Now it's getting up into the 4.27 area. We keep an eye on diesel. It's used heavily with 18-wheelers and railroads and big ships and so forth. This has been going up, and that's a little bit of a concern, and that could be somewhat inflationary. And we're still in a downtrend here on the daily chart with copper. Now, you look at the weekly chart, we're in an uptrend. We haven't seen enough of a bounce lately to actually generate a golden cross here. If this does cross over and we're in an uptrend, that could actually be positive. Copper tends to try to lead the economy. If copper's going up, the economy is perceived to be looking stronger going forward. If copper's going down, then the copper market is anticipating economic weakness. And oops, I hit the wrong button here. And then we look at a ratio between copper to gold, which continues to go down. Copper, even though it bounced back up lately, gold has been outperforming. And then here's a longer term look at that same chart, and we're seeing a real disconnect. And we have been for the last few years, where they typically will track in the same direction as the 10-year yield and the 2-year yield, but they're just getting further and further apart from each other here. And we're trying to see, does this mean something? But we've been watching this now for a few years, and it hasn't really given us a lot of insight other than that we see this divergence here. Gold is coming off of setting a recent all-time high, at least on an intraday basis. Silver is also in an uptrend as well. And we look at a gold to silver closing value correlation on the bottom, and it only stands to reason that if one is going up, the other one's typically going up. We're seeing a fairly high correlation between the two, and that just means they're going in the same direction at the same time. We look at a gold to silver ratio. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And then we can compare that to the US dollar index, and it's pretty much neutral right now. There's a little bit of shifting going on with strength that we were seeing in the dollar. Now we're seeing some weakness, and we're seeing gold outperforming here. So this correlation is right around the midpoint. The dollar is still in an uptrend as measured by the moving averages, but it has been pulling back lately. That's why it's negative in the short term, but more intermediate term, and even on the weekly chart, we're still in an uptrend there as well. We keep an eye on the euro, which is in the top part of this chart, and then look at a mirror image. It's like this is the reflection off the lake, and this is the mountains on top. They pretty much go hand in hand with each other in opposite directions. We also plot the Japanese yen down here as well. Just these are the three big currencies in the world. There's other ones too, but these are the ones that the market focuses on for the most part. And we're still in a downtrend with the euro to the dollar, but we have been bouncing back up lately. We're also in a downtrend with the yen to the dollar, but this has been seeing some recent strength here. And the British pound also bouncing up, but still in a downtrend when compared to the dollar. Then we look at some index ratios, and yes, I show this in the daily videos most of the time. When the red line, this is the equal weight version of the S&P. All stocks are treated the same versus the weighted version of the S&P. And when the red line's below it, that just means the rest of the market is underperforming, even though we've been seeing some improvements lately. We look at a ratio between the two, not really showing all that much of a change. When this is going down, that means the equal weight is underperforming the weighted version of the S&P. We look at stocks versus commodities. This could be getting a little scary here. We've been really coming down as stocks have been underperforming. They've been going sideways in a trendless environment, or commodities continue to go up, and we could be getting ready to see a death cross here. Now, we've seen death crosses before. We've actually dropped below the moving averages only to recover. But we want to make note of this if we do see a general change here. And this is showing that same thing in an inverse fashion, where commodities have been underperforming stocks. Now they're starting to improve. We do a ratio between the NASDAQ 100 and the S&P. This has been coming down lately, but for the most part, the NASDAQ 100, which are the big growth stocks, still continue to outperform. The S&P 100 is actually in a downtrend when compared to the rest of the S&P 500, but it has been showing some improvement. And the NASDAQ continues to outperform the S&P, even though it's dropping under the 50-day moving average with this ratio. The NASDAQ 100, though, it's starting to bounce back. We were really outperforming going into the summer of 2024, and then it just kind of lagged throughout the rest of the summer, into the fall, and into the winter. Now it's starting to make a bit of a comeback here with this ratio. And then we look at the mega caps, the really big stocks, and compare it with the equal weight ratio, pulling back recently, but still in an uptrend longer term. Small caps just continue to struggle. Even though the S&P was down 1.67%, I think it was, for the week, small caps were down even more. And so that's where we're seeing this ratio continuing to fall. They continue to underperform the S&P 500. The red line here, that's the small caps to S&P 500 ratio, which is just going down as the S&P, for the most part, has been going up. We set two all-time highs with the S&P in the last week. It was just Friday, ended up being quite a negative day. Mega cap growth, this is where the real strength of the market comes from. Pulling back, fell 2.21% on Friday, but still it's above its 50-day moving average, and the uptrend is still strong. The robotics and AI ETF showing some improvement here, but not really outperforming when we do a ratio with the tech sector. Dow Jones Composite Average falling back, seeing some weakness now, falling a little bit underneath its 50-day moving average, but still in an uptrend. Low volatility stocks, when you look at them all by themselves, they're looking pretty strong right now. but still underperforming when we compare it to the S&P. Now, we did see this come back up. We've seen some false signals here before. It looked like maybe the overall climate of the market was changing, and then it reversed. And when this ratio is going down, that's more positive for the market. If we continue to go up here and see a golden cross, that might mean the overall characteristics of the market are going from offensive, buy low, sell high, to defensive, which typically means a decline. And you can see this is what it was doing back in 2022 when we had the cyclical bear market. Then we look at the advanced decline line studies, and I do show this in the daily video as well. Seeing some weakness with the NYSE common stock coming back down to the moving average. We are declining with the S&P, but we're still above the moving average, falling a little bit below the moving average with the mid caps and seeing more weakness here with the small caps. And then we look at traditional Dow theory, which looks at Dow and then the transports. I also add utilities into that mix, and these showed some weakness. We saw a little bit of a bounce up here later in the week with utilities because that tends to be more defensive. We look at a ratio between the Dow and the transports, and when this is going up, which is what it's been doing now, going back to the latter part of 2023, that just means the Dow is outperforming the transports. And then we break it out and look at the transports by themselves, and they've just been chopping more or less sideways. These are previous levels that it looked like, okay, maybe we were going to go back and look stronger here. We actually set a new all-time high back in 2024. Well, now we've just settled back into this range. We look at a ratio between the transports and the S&P. Now, these are the Dow transports compared to the S&P 500, two different indexes. Overall, this has been declining. That means that the transports are underperforming the S&P 500. We look at the correlation between the S&P and the transports here. Pretty strong correlation between the two. It's just that the S&P is outperforming. Then instead of using traditional Dow theory, we swap out the Dow and exchange it for the S&P 500. This set two all-time highs this past week. This decline that you're seeing was pretty much Friday. And then the NASDAQ did not come back and set an all-time high here. So that would be considered a negative divergence, but then it also declined on Friday. We would like to see both of these hitting all-time highs roughly at about the same time, and they haven't done that yet. We break this down a little bit more. We look at the equal weight, which did not set an all-time high. Where the QQQ equal weight, that's the NASDAQ 100, it did set a recent all-time high. Another negative divergence. Now you can switch this around and look at this in a positive way, where look at the Qs, they set an all-time high. Maybe they will drag the rest of the market up with it. So it depends on your perspective. You can choose to look at this in a negative way or in a positive way. I try to look at both sides at the same time. Then the FANG index, which is coming off of setting a recent all-time high, saw a decline on Friday, almost 3%, dropping below its 50-day moving average, but longer term, we're still in an uptrend. And we fell below this longer term trend line here. Now, we fell below this before, and we were able to recoup and get back above that. We're going to be watching this to see, are we going to fall further below this? That could suggest some kind of a bigger picture change. But if we can bounce back up out of this, that just means that, okay, maybe the market overreacted on Friday, and we're just going to bounce up out of that. The Wilshire 5000 looking pretty solid. This is a broad market measure, closed down below its 50-day moving average, but it's still in a longer-term uptrend with the blue line above the red line. The blue line is a 50-period moving average, and it goes faster than the red line, which is a 200-period moving average. Total U.S. stock ETF coming off of setting a recent all-time high, but now coming back down to its 50-day moving average. Then ARK, it fell over 10% for the week, and almost 6% of that came in Friday's session. But longer term, it's still in an uptrend. The all-world ETF, which takes out U.S. stocks, this has been looking pretty solid. We're just about getting ready to see a golden cross here. And we're actually seeing this going down. That means that the SPY, which are the US stocks, they're starting to underperform the world stocks. And we haven't seen that. This is kind of strange. Is there some kind of a change in characteristic taking place? We'll keep an eye on this chart. If this ratio continues to fall, that might be more cause for concern. But we're also still above this 200-day moving average with this ratio. We came right down to this level, and that ended up providing support. So if we do fall more, we'll be seeing, is this moving average going to hold? We might be able to bounce up off of that. Even if we get down that far, we don't even know if that's going to happen. And then we look at another ratio between US and world stocks, and US stocks have been pulling back lately, and we're starting to turn down with the momentum oscillator. And this is a monthly chart, so this is quite long term. And then we look at small caps to tech. Well, tech's been under a little bit of pressure lately, but small caps have been doing even worse. So we're still continuing to go down here. This is just the price of bonds. I do a lot of other studies that talk about the yield of bonds, but this really was able to spike up on Friday, and that drove interest rates for the 10-year yield down below 4.5%. And we're actually below that right now, which could be positive for the market. It just didn't see it that way in Friday's session. Then this is bonds based on price. Earlier on in 2025, we were really watching this 200-day moving average. So far, we've been able to bounce back above that. And we're in a very tentative uptrend now. World bonds, though, are still in a downtrend. They just fell off a cliff, but now they're starting to bounce back up. And the stock to bond ratio, this is a monthly chart showing how stocks are outperforming, even though we have seen some recent weakness. This also is a daily chart. When this goes down, that means bonds are underperforming stocks. High yield bonds, these are junk bonds. They were down, but they're still looking pretty solid overall, and they tend to follow the stock market. And we look at a ratio between junk bonds and more conservative government bonds. Still, folks are tending to prefer the junk bonds. They're willing to assume more risk to get a better yield. If everything was getting ready to fall apart, they probably wouldn't be doing that. And then corporate bonds here, getting really close to seeing a death cross, but they are starting to bounce back up based on price. And we look at a stock to bond correlation, neutral right now. They're not really going in one direction or the other. Corporate bonds also getting close here to a death cross, but we have seen some price action above these moving averages lately. And then I have some fib retracement studies on here, but we're far away from these blue lines, so we're really not getting anything here. These are just charts that I show every week, even if they're not really telling us anything. And this goes back to 1980, showing that we are overall setting a higher range for interest rates. Another fib retracement study with the 30-year yield, also in between the blue lines, not getting any insight there. Junk bonds continue to do very well when you look at them by themselves, and they're also outperforming government bonds when we do a ratio. And then we are starting to come back down. At least the last few sessions, we've been seeing, this is a daily chart of the yields coming down. Now, if these continue to fall, that may give some support to stocks. This going back up is what was pressuring stocks, especially when we got above that 4.5% level with the 10-year yield. This is a weekly chart, and what we're really honing in on here is the red line. We're going up with Japanese rates, and is that going to cause a problem in Japan like it did last summer and end up flowing throughout the whole globe? Hasn't happened yet, but we're keeping an eye on that. Then we look at a monthly chart of the price of the 30-year bond, still in a downtrend. And then we do a ratio between the long-term bond and commodities, starting to roll over here, where even though the 30-year bond was going down, it was still outperforming commodities, but that could be getting ready to change. And then we look at some ratios between stocks and bonds. And this is the S&P to 1 to 3-year bonds, showing some weakness, but still holding up. We're not seeing a big change there. Then we look at the S&P 1500 with short-term bonds, seeing some weakness here, but still holding up. Another broad market measure, and then we look at 3 to 7-year bonds, seeing some weakness here, but we're still near the high end of the rainbow. The tech sector to 3 to 7-year bonds, weakness, but still at the high end of the rainbow. And we look at stocks to the 10-year yield. Now, this could be getting ready to change here. The S&P 500 has been in an uptrend when compared to the 10-year yield. That might be getting ready to change, but we've been seeing a lot of sideways action going back into January. This also shows how bonds are underperforming stocks, even though they've been bouncing back up lately. And then we look at the volatility of bonds as measured by the MOVE index. I follow the red line, and overall that's been coming down, which means fear has been decreasing in the bond market. And then the VIX, we also can follow the moving average, and it's been pretty level. Now, this spike that you see up, that was the decline that we saw on Friday. And we see at the bottom that there's a fairly strong correlation between the volatility of bonds and the volatility of stocks. Then we look at different sectors. The material sector is in a downtrend, but they have been bouncing back up, trying to get back above their 200-day moving average. But they declined with pretty much everything else on Friday. And now they're coming back down to the 50-period moving average. And when we do a ratio between materials and the S&P, still in a downtrend. Means the material sector is underperforming. Communication, this is a growth area. Got hammered on Friday, like pretty much everything else. But it's still outperforming the S&P when we do a ratio. This is a growth area. We want this area to do well if we're positive on the market. Energy, in a downtrend, but just chopping around all over the place, going above and below the various moving averages here. But when we do a ratio between energy and the S&P, energy is still underperforming. Financials, seeing some recent weakness here, but still above their 50-day moving average. And one of the stronger areas currently in an uptrend and actually outperforming on a shorter term basis when we compare it to the S&P. Industrials, hanging out above their 50-day moving average, but got hit on Friday. And we're actually showing a downtrend here when we compare the industrials to the S&P 500. The tech sector, the darling of the stock market here, coming back down to its 50-day moving average and kind of going sideways right now when you compare it to the S&P and actually in a downtrend. And we saw that happen where it really was outperforming up until the summer. Then it started to drop off and we've been going sideways, where the tech sector has not been the leader lately. The staple sector, looking at this all by itself, and it is in an uptrend, even though the 50 and 200-day moving averages are getting kind of close to each other. And it's spiking up lately, but still, this ratio is going down when we compare staples to the S&P. Real estate, trying to make a bit of a stand here and go back up, but it doesn't like those higher interest rates. And so it's underperforming when we compare it to the S&P, even though it's spiked up this past week. Utilities also in an uptrend, but they've been really slowing down. They had been going up really solid for most of 2024. Now they're just starting to chop around. And they are in a downtrend when compared to the S&P, but they did break above their 200-day moving average with this ratio. We look at a S&P to utilities ratio, very choppy lately. So I haven't been showing this that much in the daily videos. Healthcare, which is more defensive, in a downtrend, trying to hang out around its 200-day moving average. But when you compare it to the S&P, even though it bounced up this past week, it's still underperforming longer term. Discretionary, this, if you go back to August, this was the end of the world day. And this sector performed the best up until about halfway through December. And it's really been languishing ever since and dropping below its 50-day moving average, even though it's still in an uptrend. And it's still in an uptrend when compared to the S&P, but falling down below its 50-day moving average. Semiconductors. Now, this chart, there's a lot of different semiconductor. I look at ETFs, and there's a couple of different indexes. Over the years, I've kind of settled on the SOX index. This is in a downtrend where the blue line's below the red line. We were starting to break above both of these moving averages, and then Friday happened and we dropped back down. Growth stocks compared to secure, safe government bonds have been showing that growth stocks are outperforming, even though they did pull back on Friday. The energy sector still is continuing to underperform the tech sector. Technology is starting to underperform the rise in interest rates. This is a bit of a concern, and we're going to see if this will continue. We've seen this before, and then it was able to recuperate. We'll see if that happens now. And this is an inverse of that same chart where the 10-year yield is now starting to outperform the tech sector, which could be concerning. And then discretionary to staples. Discretionary is still in an uptrend compared to staples, but really pulling back lately. And then we do an inverse. Staples are underperforming discretionary, but lately, going back to the beginning of February, they've been really outperforming. Gold to the S&P, just kind of chopping along sideways. And the S&P lately, for the last number of weeks, has been trendless. Gold has been going up, and that's why we're seeing a little bit of an improvement with this ratio. But neither one is really outperforming the other all that much. Gold is back to outperforming the dollar, as the dollar has been seeing some recent weakness and gold has been seeing some strength. That's why we're seeing this ratio going up. The NYC composite, this is a broad market measure. And even though it was down 1.33% on Friday, we're still above the 50-day moving average. So this index is not falling apart. High leverage loans still above their 50-day moving average. This is another proxy that I use to kind of gauge economic conditions. This still looks strong. And then all stocks, which includes US and international stocks, did decline, but still above their 50-day moving average. Emerging markets, seeing some strength there, actually enough to generate a golden cross here. So this has been improving over the last few weeks. And the Japanese Nikkei just kind of hanging out around the same level for a long time, going back to the beginning of 2024. Microcaps saw some weakness, but still in an uptrend. These are the really small stocks. And we're not seeing much of a change here. We do a correlation between the S&P and the home builders ETF. It's been underperforming, but we're not seeing much of a change here with the correlation between the two. Bitcoin just cannot seem to stay for any length of time above 100,000. And it's in the 96.5 range right now. And we're going up in China. Now, this is a long-term oscillator called the KST. So we are in an uptrend in China, emerging markets. Europe's in an uptrend. Europe's been really strong lately, especially in Germany. Japan's in an uptrend. And we're still technically in an uptrend here, but we're showing a little bit more weakness with the S&P 500. Then going back to the beginning of the year, gold is doing the best. And then we have bonds based on price. That's the blue line in second place. Then stocks in third place, then oil, and then the dollar has been the weakest going back to the beginning of the year. It showed a lot of its strength back in 2024. And then we look at correlations, getting close to being neutral when we compare the S&P to the dollar, but they're still having a slight tendency to go in opposite directions. The S&P to oil starting to go in the same basic direction, down, because oil has been falling and the S&P has been falling. That's why we're seeing this correlation showing a little bit of strength. And then the S&P to the 10-year yield also showing a little bit of strength here where it had been neutral for a while. The tech sector to the 10-year yield coming back down and getting a bit more neutral right now. Then the S&P to the 2-year yield, short term, still in this neutral area currently. Then we look at some long-term charts. This is a monthly chart of the NYSE composite, still looking pretty solid here. But if you look at the Copic curve, which is a momentum oscillator, this is starting to flatten out and actually turn down a little bit. Now, this is going to update. Since this is a monthly chart and we have 1 week left of February, we'll see what happens when this chart redraws at the beginning of March. Here's a daily chart where we're still looking okay. We've been going up since the beginning of 2025 with the NYSE record high percent index. And then here's a monthly chart of the S&P, still holding up above the moving average, but we're seeing some rolling over and actually turning negative with the percentage price oscillator, or the PPO. Then we look at the S&P on top, and we look at a ratio between stocks and commodities. Stocks have been outperforming, but even longer term, we're seeing this rolling over a little bit. If commodities stay strong, this ratio could continue to go down, and that might be a concern that has to do more with inflation. And then we look at another global monthly chart here of US versus global stocks, showing some recent weakness, but still above the advancing moving average. And the KST, a long-term momentum oscillator, is still positive. So then at the end, I look through the positive things, and my definition is when the 50-period moving average is above the 200-period moving average, and growth and value are positive when you look at them by themselves. The dollar is still in an uptrend longer term. The CRB index, gold and silver as well are in uptrends, as are the mega caps, the FANG index, the really big stocks. ARC is still in an upturn, even though it got hammered this past week, especially on Friday. The low volatility ETF, when you look at it by itself, staples are in an uptrend, but seeing a little bit of weakness, could be getting ready to see a death cross there. The Dow Jones Composite Average, that takes the Dow, the transports, and the utilities and puts them together. Bonds based on price, just world bonds are the ones that are not on this list. The tech sector, high leverage loans, the Dow, the NYSE Composite, and Wilshire, those are two broad market measures. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps. Now, seeing a lot of weakness lately with the mid caps and small caps, but they haven't shifted over into a negative trend yet. All stocks are still in an uptrend, as are emerging markets and Bitcoin, even though it can't seem to stay above 100,000. Then the negative side, this is when the 50-period simple moving average is below the 200-period moving average. Copper is still in a downtrend there. And then the euro, yen, British pound, when you compare it to the dollar, even though the dollar's been showing some recent weakness, there's still in longer term downtrends when compared to the dollar. And then when I look at the SOX index, that's negative, but some of the ETFs and other indexes that we look at are actually still positive. The World Bond Index is also positive as well. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.